Okay. So today I'll start with the investment fund and how the investments will work and the basics about the investment fund and what are the concepts will be there in the investment fund. Even before we starting with the fund accounting, we have to discuss about the investments and funds. So even before that, let me recap the previous class. So we spoke about all secondary market, right? And also we spoke about types of shares like equity shares, preference shares, what is cumulative preference shares, what is non-cumulative preference shares. In addition to that, we also spoke what is subscription, what is redemption, and what kind of returns will get. To the equity shareholders, to the preference shareholders. If we are getting any loan from any bank or financial institution, what we have to pay, how the profit distribution will be done among the equity shareholders, profit shareholders, and also the loans. All these things we discussed, right?
Yes, Mahesh.
So today class, let me talk about again. I have to talk few more things about the same concept like own funds, loan funds we are discussing, right? Own fund is something related to bonus fund, and loan fund is something that we borrowed money from the financial institutions. Okay, this is how we spoke. Let's assume bonus fund. How we are actually selling the shares to the public as an equity shareholder or maybe a preference shareholder. When we are collecting capital in the form of equity share capital or preference share capital, how we are collecting the shares? The capital from the public or maybe from the different types of investors. We have like high net worth investors, retail investors, and also institutional investors. How we are collecting these funds from them?
To selling the shares.
So basically, we
Shares
have created a shares and we are selling the shares,
Yes.
right?
Yes.
So shares, is it a asset or liability to the fund? Suppose if I collected some capital from the different partners and different uh, people, I have collected a capital by issuing my shares. The shares are a liability or asset to the company.
Liability. Liability.
Any other answers from anyone?
It is a liability.
Okay, maybe for commerce students, I think we are pretty much sure it's a liability. It's a liability side. But I'll try to explain why it is a liability. Because for non-commerce students, you may get surprised as a capital we are receiving from the investors. So it would be company
Yes,
asset
yes,
only,
yes.
right? Why we have to consider this as a liability? Let me explain in this way. So if I'm contributing some capital to the business, I'll have a right to withdraw my capital as well, right? Or maybe I can sell my capital to others. At the time of liquidation, company should also repay that capital to the investors. Yesterday we discussed, right? At the time of liquidation of a capital, at the time of liquidation of company, we have to pay back the capital to the equity shareholders and we have to pay back to the preference shareholders. Then loan also need to be repaid. All these amounts we need to repay, right?
Yes.
So whenever there is an obligation on company on repayment of capital and repayment of any cash flow, that needs to be considered as a liability. It can be a loan or it can be capital, whatever it is. If there is an obligation of a future outflows of cash flows, future outflows of cash flows, outflow is nothing but it's going away from the company. It's going out of the company. That is called outflow. So whenever there is a cash outflow from the company, that needs to be considered as a liability. Understood? Now you got clarified why this capital needs to be considered as a liability. Is everyone clear with this?
Once again, Mahesh.
Okay, I'll explain one more time.
Yes.
Suppose loan we assure, right, as a liability. We are all know loan means we have to repay the interest and also we have to repay the principal amount.
Yes.
So in this loan, we have an obligation on payment of interest as well as the payment of principal
That's right.
amount. So there is a clear-cut definition. It is an obligation. So we can consider this amount as a liability.
Liability.
It's a loan only. Loan debt, whatever it is a liability. You know the meaning of liability first? What is
We have
liability?
to pay. We have to pay money.
Whenever there is an obligation for the payment, whenever there is an obligation, not an option, it is an obligation
It's a
for the payment.
mandatory.
That is called liability. That needs to be considered as a liability. So here, loan is a liability. Maybe after a certain period of maturity, we have to repay the loan amount, principal amount as well as the interest amount. That's why we can categorize this as a liability. Similarly, the capital also we are considering it as a liability. Why we have to consider this capital as a liability? They're the owners and they have contributed capital. We are doing a business, right?
Yes.
Yes, we are doing a business with those contributions. But at the time of liquidation, What do you mean by liquidation? It's the closing of a business. When we want to close a business, we have to distribute capital also to the shareholders, right? Whatever
Yes,
the
Mahesh.
assets we have, we will sell all the assets at market price. Whatever the amount realized. Here in the previous example, we have realized 10,000. Out of this 10,000, 7,000 distributed to equity shareholders, and a preference share capital also got distributed, not 7,000 to the equity shareholders. This is a wrong example. So we have to distribute that amount to the equity shareholders, then preference share capital, then loan amount. All this amount need to be repaid. So along with the loan, we are repaying the capital to the equity shareholders also, right?
Yes, Mahesh.
So it's an obligation.
Mm.
Let's understand it in layman terms. Suppose you and me started a partnership firm. You and me only started a partnership firm. Both we contributed like 10 lakhs capital. You bought like 5 lakhs capital. I brought 5 lakhs capital. When we are closing the business, again we have a right to get back our capital from the business, right? Whatever the amount, it can be 8 lakhs or it can be 20 lakhs. The moment when you sell the entire business assets, whatever the amount we have realized, that amount will be distributed between the partners. We are not leaving to the someone else, right? It's a company fund. We are leaving to the company only. We're not leaving to anyone, right? As a partners, we're collecting back our money. Am I correct or not?
Yes, Mahesh.
So from the company perspective, it is an obligation for the company only.
Yes, yes.
The company, they have to pay back to the partners, to the shareholders. That's why we have to consider it as a liability. It can be equity share capital or a preference share capital. Even if it is a loan, we have to consider this as a liability only.
Okay.
Now it's clarified.
Yes, Mahesh.
Yeah, I got one more doubt. What is that? I'll explain the process. I thought this also I have to explain. Equity share capital, preference share capital need to be repaid. That's why we are considering it as a liability. Okay, not able to remember that. Okay, let me continue. So that's why we are considering it as a liability.
Liability.
Okay, yeah. Why we have to pay back to the shareholders? Why we have to pay back to the partners? They only started a business. They're also owners, right? Why we have to pay back our capital, company's capital? Why we have to distribute capital to the owners? There is a concept called entity concepts, business entity concept. Business entity concept. You know what is this business entity concept? The day one itself we discussed about it. You know what it explains actually? All the accounting will start from the concepts and conventions. We have a concepts and conventions. So the major concept is business entity concept. It talks about the ownership of our partners or maybe the owners of our company. It will talk about the ownership. So as per this concept, as per the business entity concept, once we start the business, like people will come and they will incorporate the company. They we call it as owners or promoters. They will come forward as a partners. They will start their business, right? The moment when it's incorporated as a business, it can be a partnership business, it can be a private limited, whatever it is. Persons are different and the company is different. Persons are different and the company is different. Suppose if I'm a owner, if I'm doing any transaction with the same company, suppose there is a Ambani. Ambani is doing some transaction with Reliance. Maybe he go to some Reliance store if he's purchasing anything. That is also need to be considered as a business transaction in his business books of accounts. In the Reliance books of accounts, even that needs to be considered as a business transaction. Suppose if he is withdrawing any cash balance from the Reliance bank account, that also need to be considered as a business transaction. That is called business entity concept. Though we are owners, if we are collecting, if we are doing any transaction in the business, that transactions also be need to be considered as a business transaction only. Though it's a bonus, it may be a purchasing of goods, it may be withdrawal of cash, it may be acquiring of services from the same company, whatever it is, that needs to be considered as a transaction, business transaction. That is called business entity concept. Now you understood why we have to repay this capital to the owners and partners.
Yes, Mahesh.
There is a concept called business entity concept. Okay. Okay. Then, yeah. So yesterday we spoke, right? Equity share capital and a preference share capital. Both are owners fund. Both are bonus only. But there will be a different time duration, different time bound for each capital. If it is a preference share capital, there will be a time bound, let's say for 10 years or 20 years. After 10 years or 20 years, whatever the amount we have mentioned in the share capital certificate, as per that duration, the amount of capital will be reimbursed to the owners. I mean the shareholders. And again, the share will be redeemed from the shareholder. That is called preference share capital. Like that, it can be own fund or loan fund. There will be contributions, and also there will be certain repayments as well in few cases. So if you want to collect a huge capital, it's not possible from one person to collect, right? As a company, if I need 10 crores or 100 crores, we do not have a possibility to collect the entire capital from the single person, or maybe from the single high net worth investors, maybe from the single retail investors. It's not possible for them to collect. Agree or not?
Yes, Manish.
That's why what we did, we have divided the entire capital into number of shares. Suppose if I need
Yes, sir.
100 crores, I have divided like a 10 lakh shares. Each share value is 1000 rupees or 100 rupees. Like that, I have divided into number of shares, equal number of shares. Then I'm selling those shares to the public and different types of people, different types of investors. I'm selling. Similarly, suppose if I need a loan, this is a loan, right? If I need a loan like a 5,000 crores or a 10,000 crores, is it possible for the business to get the entire loan from one bank or one financial institution?
No,
Definitely, no, they
Not
won't even
possible.
help. Because
no,
again,
sir.
on the first day itself, we spoke how the banks normally will provide loans and borrowings. They will always check the credit worthiness. To allot that kind of a huge amount, they may need to check a lot of things. Even there won't be possibility to get the entire loan from one bank or one financial institution from the company's side. For that reason, what they will do, even this loan amount also will be divided into multiple parts, like how we divided the capital into multiple number of shares. Similarly, the loan amount also will be divided into huge number of shares. Shares are nothing but parts. Let's decide like this. We have a requirement of loan, say like 10 lakhs. Just for an example, I'm taking this as a 10 lakhs we have a requirement. Okay. So what I do, as a small business, if I need 10 lakhs, it's not possible for me to collect the entire 10 lakhs loan from the one bank or financial institution. So what I'll do, I'll divide this loan also to number of parts. I'm dividing it as a 1 lakh. What would be the price of each part?
10.
Each part of loan.
10.
So this 10 lakhs divided by 1 lakh. So 10. Let me reduce it to the 10,000 parts. So I have divided into 10,000 parts. Each part value is 100. So what I'm doing, again, I'll sell this loan parts to the public. Again, I sell this 100 loan parts to the public. Again, number of people will come and purchase this loan parts. While they're purchasing this preference shares and equity shares, in return, what they're getting every year?
Dividend.
Dividend. Already we spoke about it, right? Profit.
Yes.
The profit will be distributed, and the profit distribution we call it as a dividend.
Dividend.
Similarly, if I am purchasing a loan part, I should also get some return, right?
Yes.
Yes,
They are the
Manish.
owners. Equity shareholders and the preference shareholders are the owners. So they're contributing. I mean, they're sharing profits. They're participating in the profit distribution. But here we are not owners. As a lender, if I'm getting a loan from the bank won't rely on profits. It doesn't matter whether you're in a profits, whether you're in a losses. You have to pay interest to the bank, isn't it?
Yes.
Similarly,
Manish.
they have divided this entire loan requirement into 10,000 parts, and they're collecting the loan amount from 100 persons. 10,000 persons. Each person will contribute 100 rupees loan, 100 rupees loan, 100 rupees loan, so that they can meet their requirement of loan up to 10 lakhs. If I'm giving a loan, definitely I'll also expect some return, right?
Yes.
If you're giving any lendings, to someone else. It is also lending only. Borrowing is, they are getting a loan from the bank. That is a lending. Bank is lending 10 lakh rupees to so and so company. Similarly, if the company is getting 100 rupees loan from you, that means you are lending 100 rupees to that company. If you are lending 100 rupees to the company, you'll also expect some return, right?
Yes.
So what kind of return you will expect? Jay Kumar, if you are lending some money to someone else, what you will expect? Jayashree,
Yes, Mahesh.
if you are lending some amount to the someone else, what kind of return you will expect? I need an answer from Jayashree. You are lending some amount. You know the meaning of lending, right? I can't hear you, Jayashree. నువ్వు అప్పుగా ఇస్తున్నావు మా వేరే వాళ్ళకి 100 rupees or 10,000 rupees. What you will expect in return?
I don't remember what they gave that time. So some question.
I understand it's a waste of time.
Was failed now.
Okay, guys. Deepak,
Okay.
Suresh.
Yes, bro.
So in return, if you are giving a loan, if you are lending some amount to someone else, in return, what you will expect?
By expecting an interest.
Interest, right? That's what I'm asking. It's a simple thing, right? Why you are worrying about it? If you are lending something, we'll expect some interest. And also on maturity, let's say like they may borrow for like 1 second. They may borrow for specific purpose and specific period. Let's say for 10 years or 5 years, 2 years. After 2 years or 5 years, what do you expect? The principal
Yeah.
amount, whatever the lending amount we have given,
Capital.
that amount also we
And
will
the
expect.
price we have given, we'll expect that money.
Yeah, same amount. The principal amount we'll expect, and also on a monthly basis or periodical basis, on a yearly basis,
Capital with
semi-annually
interest.
or quarterly, we will expect interest also. So
Yes.
understand, if you are contributing capital in the form of preference share capital or equity share capital, basically if it is a capital part, we will expect profit sharing. We will expect profit sharing. No, sir, I'm not contributing in the form of capital. I'm contributing in the form of loan. They're asking for the loan requirement. So I'll go and purchase one part of loan. So that every month or every year, what I'll get? Interest I'll get.
Interest.
And also there will be security. I don't need to worry about profits because profit doesn't impact my returns. Irrespective of a profits, irrespective profitability position of the company, I'll get an interest. And at the end of the maturity period, I'll also get my principal amount.
Principal amount.
Right? Everyone understanding?
Yes,
Yes,
Mahesh.
Yes,
Mahesh.
Mahesh.
Yeah. Now the same amount. We are talking about loan parts of loan. It's a bit messy. So let me keep it in a technical terms. We have a specific word for this loan parts. That is nothing but debentures. You guys have heard about it? Debentures?
Yes, Mahesh.
Yes, Mahesh.
Debentures, or we can say bonds also.
Bonds.
Okay, these are all types of bond instruments, loan instruments. We call it as a loan instruments.
That instruments.
These are all called loan or debt instruments. Even technically, we want to speak debt instruments. We call it as debt instruments. So in this debt instruments, the loan requirement, whatever the company required, loan or a debt, they have divided into 10,000 debentures or 10,000 bonds. Each bond value is, each debenture or bond value is how much?
100.
100.
100 rupees.
100 rupees.
If I
100
purchase,
rupees.
yeah, if I purchase 100 rupees bond, let's assume they are giving this debentures or bonds at the rate of 3%. At the rate of 3%. Let's assume this 3% is per annum. 3% is per annum. Now, every year, how much return I'll get? Every year, how much return I'll get? Suppose if I purchase one bond at 100 rupees. Each bond is carrying how much interest?
3%.
3 rupees.
3%.
3 rupees.
3%. So how much interest I'll get?
3 rupees.
So 3 rupees
3
interest I'll
rupees,
get,
sir.
right? This is the interest part,
Yes, sir.
3 rupees. Everyone understanding?
Yes, sir.
So if I'm contributing capital in the form of debentures, bonds, or a loan, we are getting the return called interest. If I'm contributing the capital, we call it as dividend. Whatever the return we are
Dividend.
receiving as a profit share, that's we call it as a dividend.
Dividend.
Have you understood?
Yes, yes, yes.
Yes, Mahesh.
Okay. If I'm holding a bond, can I call it as an investor? These persons have invested in a capital, so they are calling as a investors, equity shareholders. The
Shareholders.
investor type is equity shareholder. If I'm contributing capital in the preference share capital, I purchase preference share. We are calling it as a preference shareholder.
Shareholder.
So here what I'm holding? Am I holding a bond? Am I holding a debenture?
Bond holder. eh?
Bond.
So if I'm holding a debenture, I'll call it, I'll be called as debenture holder. Debenture
Or
holder.
bond holder.
If I'm holding
Or
bond,
or bond
I'll be
holder.
called as bond holder.
Bond holder.
Both are investors only. Debenture holder is also an investor. Bond holder is also an investor.
Okay, sir.
Why they're investing in bonds? Why they're investing in capital? What would be the purpose? Which is more risky? Investing in a bonds is more risky, or investing in equity share capital or preference share capital is more risky?
Investing in equity share is risky. Even profits also same like that. Even debentures and holders, there is no risk.
So in terms of risk wise, the equity share capital or maybe the preference share capital. Let's forget about preference share capital. It's just a type of capital. Okay. Even again, there will be fluctuations in the share price, even in the preference share capital also. Okay. Now let's talk about the capital. We are not going forward. We are not going to differentiate the capital as a preference share capital or equity share capital. We are going to call it as capital itself, equity. We call it as equity only. Again, in the equity, we have a classification: equity share capital, preference share capital. So going forward, whenever I quote the word called equity, it's nothing but capital. So investing in equity is more risky. Why it is more risky? Because it's a real capital. Always the returns on investor. Always the returns on capital, returns on the business will impact their profitability share. If the company is getting a huge profits, definitely they will have a chance to get a huge returns in the form of dividend. If company is in loss, they will have to bear the loss, isn't it?
Yes, ma'am.
So that's why
Yes,
the
ma'am.
risk element will be more in case of equity part, capital part. But in case of debentures, in case of a bonds, there is no risk on return, because irrespective the profitability position of the company, they'll get a return. So the risk is very less in case of debentures or loans. But whose return is more? We are talking about risk. Risk-wise, yes, bond is less risky and equity is more risky. Let me keep it in this way. Like we have a bonds and we have a, let me type 1 second, equity, and we have a bond. Okay, we are talking about risk wise, right? Equity is having high risk
High risk, low risk.
and it is a low risk. And we are going to talk about return. So which one will have a high returns chances?
Equity.
Is the returns.
While we are considering these factors, risk factor, return factor, we have to consider only that specific factor. Again, you cannot go back and jump risk wise, return wise. If I'm talking about risk, forget about return. Just consider only the risk element. In terms of risk, yes, equity is high risk and bond is low risk. You guys are good with this, right?
Yes.
Mahesh.
Then, in terms of return, which one will have high chances of return? Equity or bond?
Equity.
Equity.
Equity will have a high returns
High returns.
because there is no limit for the return. But in case of bond, always there is a cap. The fixed rate of return will be receiving by the bond holders. That's why the return will be low in case of bond holders. Okay. And we have one more thing, liquidity. You know what is liquidity? Not liquidity. Not liquidity. We have to talk about 1 second. Not liquidity. Dilution. Ownership dilution.
Yes.
You know what is ownership dilution?
We have to sell the shares or close the bonds.
So the dilution means, suppose let's assume it in simple words. We have like a two partners, or let's assume three partners. We have like a three partners. Okay. Each partner contributed like 30,000, 40,000, and 30,000 like that. We have like that. Each partner contributed different capital structures. We have total like 1 lakh capital. If we want to take a decision, how many partners need to agree? Let's assume it in this way. We have like three partners. Okay. Partner A, partner B, and partner C. Partner A contributed 30,000 and partner B also contributed 30,000. Partner C contributed 40,000. Okay. Now, if they want to take any decision, altogether we get 1 lakh. So partner A share is 30%. Partner A share is, here I'll write the share as well. He's having 30%. He's also having 30%. And he's also having 40%.
40%.
Okay. Total we have 100%. 100%. Now, another partner also contributed capital. Another partner also entered, D entered, and he has contributed 60,000. Now, what would be the percentage of share in D, in A, B, C? Is it something like 60%? Altogether, we can have
No, it's
160%.
No,
Do you
No,
calculate like that
One
percentage?
No.
60%.
So
No,
in that
sir.
case, what we have to calculate? How we have to calculate? Suppose B is contributing. What is the total of cash? We'll understand. What is the
16,000.
total capital? 1 lakh
16,000.
60,000.
It's
Now
1
we
lakh
want to,
Oh, sorry, 1,60,000.
if you want to know the share of A by
By
Yes.
1,60,000.
total.
into 100.
100.
So 18%. So what happened with the share? Earlier A had a 30%, now it has reduced to 18%. 30 this person B share also reduced to 18%.
18%.
40% share
Yeah,
reduced to
also.
25%. He is contributing 37% share. So what happened with this ratio? By admitting a new partner, new shareholder, the ownership has reduced or increased.
Reduced.
This is called dilution. Because of new partner and new share capital, this existing owners are diluting their ownership stake, isn't it?
Yeah.
The capital is
Yes.
same. The capital is
Yes.
same, 30,000, 30,000. Because of admitting new partners, the position, the stake, earlier we had 30% stake, now it's reduced to 18%. So the ownership stake are diluted, right?
Yes.
Yes.
Diluted.
This is called ownership dilution. So now tell me, which one will have a dilution chances? Equity or a bond?
Equity.
Equity will have a chances of low, high, and this is a low.
High.
Low. No chance for that.
No chance at all. There is no chance, not
Yes.
even low. There is no chance
is
even
no
for
chance.
no. Yeah.
Why? Because that's a lending.
It's a
we have
bond.
to
They are not
bond.
contributing. How much you can get any kind of loan and to any extent. There won't be ownership dilution. But because of contributing additional capital by the additional investor, additional partner, additional shareholder, there will be dilution in the ownership. Understood, everyone?
Yes.
About ownership dilution also.
Exactly.
Yeah. So basically, we are trying to enter into the debt market instruments. That's why I've explained all this concept. What we call it is debentures. What is the bond? What kind of return we will get if I invested into the debt market, debt instruments. This is all the concept related to the bonds, fixed income securities. We also call it as fixed income securities. Okay. Now we will talk about bonds and fixed income securities. Even before that, I'll have to talk about capital. Okay, let's talk about capital and bonds together today. As a capital, if company receiving capital contribution from the different shareholders on a monthly basis, I mean on an annual basis, whenever they get a profit, so what they have to pay? What they have to pay?
Dividend.
They have to pay dividend. So what do you mean by dividend? We understood, right? What do you mean by dividend? What is the dividend?
Dividend is nothing but profit.
Distribution of profits, sir.
Distribution of capital. I mean profits.
Yes, sir.
Distribution of profits, we call it as a A dividend.
Dividend.
Whatever the amount we have earned for the whole financial year, we will keep some amount for the future purpose as a reserves, and remaining amount will be distributed among the partners. That's we call it as a dividend. And as the equity shareholders, they always have a voting rights. This also we spoke. So how they will decide, sir, dividend, how much dividend we have to pay to the investors, who will decide and how they will decide. There will be board of directors in every company. Board of directors.
Yes, sir.
So the board of directors, there will be an annual general meeting, AGM, or general meetings, board meetings. And all. So in those annual general meetings, they will decide how much percentage of profits need to be distributed to the investors. I mean, to the profit, shareholders, how much profit we have to pay back. Like that, they will decide and they will announce the profit. Okay. And similarly, for the bond holders also, while issuing the bond itself, they will mention very clearly how much how much interest rate will be paid on this bond, and what is the maturity period, what is the face value. Everything will be given in the bond certificate. We will receive a share certificate if you are purchasing the share. Similarly, bonds also, there will be bond certificate. Bond is nothing but like a agreement bond. In the first day itself we spoke, right? Bond means normally if you're giving any lending to someone else, we used to enter into an agreement, right? Bond paper. We'll write bond paper. I'm borrowing this much money from so and so person for so interest rate. This is the purpose. After this many years, I'll repay this money with interest. Like that, we will enter into an agreement, right? Bond paper. That is nothing but a bond. Similarly, company will also issue one bond paper. Okay. On bond paper, there will be clearly content. I mean, the agreement terms and conditions will be written. What is the maturity period? What is the interest? And how we will pay this interest? How many, what is the payment period of interest? Is it a quarterly interest or a semi-annually or annually or monthly? Like that, all these terms and conditions will be written in the bond certificate. Okay. Now we understood the basics about equity and bond, right? Shall we move on to the bond market? Everyone?
Okay, okay.
Shall we move on to the bond market?
Yes, Mahesh.
Anyone have any questions as of now?
No.
No, Mahesh.
Okay.
Some political parties are using electronic bonds.
Come again?
Some political parties are using electronic bonds.
Electoral bonds, yeah.
Yes.
Hmm.
What is the reason?
We'll talk about it. Just we're entering into the bonds. We'll discuss about types of bonds, how the interest payment will be calculated, what is the yield to maturity, YTM, what is dirty price, clean price, how we will post a journal entries while purchasing the bond, for receiving an interest, how we will account it. Everything we will discuss in the bond market. Don't need to jump onto the next topic. Okay. We have many things to discuss here. We will discuss about that one as well. It's a hot topic, I know. We will discuss about the electoral bond as well. Okay. Yeah. So we are talking about bond. Basically, first we'll understand the bond and bond market actually. So bond market, we all know it's a debt instrument. What is debt instrument? What do you mean by debt instrument?
This is not a capital. This is the debt to the company. Bonds.
It's a debt
We have
instrument.
to-
Means it's not a
Yes.
capital. It's a part of debt. So if I'm paying some, if I'm receiving some debt, debt capital from the different investors, I have to pay interest rate.
Yes.
So interest, is it going to be expense or income to the company?
Expense.
Is everyone sure?
Yes, Mahesh,
They are
it is expense.
Is it an expense or income?
Expenses.
They are paying interest, so money will go out from the
So we
company.
are paying interest. From the company perspective, company is paying interest. So interest is an expense to the
Company.
company. And there is one more person on the opposite side, bond holder. Bond holder or investor.
Yes,
So to the investor, is it going to be income or
those
expense?
It's income.
What is income?
It's an
sir.
income. It's an income. And is it like every month the interest income is going to be changing, or is it going to be the same income?
Same
Fixed
income,
income,
sir.
fixed income.
Fixed interest
The
based
fixed
on
income, right? Every month there will be
capital.
There
the
is
fixed
no
income.
changes of
Yeah. So there is no change, and every month it will be fixed only. So
Fixed
can we
interest.
yeah. So can we say this role fixed income instruments or fixed income securities?
Yes,
Yes, for
Fixed
the
income.
securities, yes, for bond
So
holders.
this role fixed
For
income
bond,
security.
securities.
this is fixed income securities for bond holders.
Yes. So fixed income securities, because every month we will be receiving
Fixed interest.
fixed interest only. We are not going to change the interest amount.
Mm.
Whatever the amount and whatever the interest rate determined at the time of purchasing a bond, we will be getting the same
Fixed amount of interest.
fixed amount of interest. So we can call it as fixed income
Fixed income
securities.
securities.
Just give me a minute, guys. Just give me a quick minute. Just give me a minute. Yeah. So we are trying to understand the fixed income securities here. So as a fixed income securities, the bond holder or fixed income security holder, we will get fixed rate of return.
Paying fixed rate of interest.
Yeah. We have a capital. Suppose company wants to get a capital, they are going to the capital markets, right? If they want to get a bond, I mean a bond capital in the form of bonds and debt instruments, where they have to go? There should be market, right? We have a capital
Bond
market.
market.
Similarly, there should be a market for the bonds as well, right?
Bonds also. Bond market.
That's why we have a capital called bond market as well. Bond market is also type of financial market only. But what we can get, we can issue the debt securities, debt instruments to the public, and we can get debt capital from the investors and public to the company. So that's the purpose of having this bond market.
Bond market.
So do we have a primary market and secondary market in this bond as well? Do you have a primary market and secondary market in the bond market as well? Anyone got any that kind of question?
But I don't know. Maybe because they are also issuing first time bond.
Yes. IPO, the primary market is not only for the capital, guys. What actually the meaning of IPO and primary market is? Wherever there is
issuing
securities earlier,
new money.
In the securities
basically
for the
they're
first time.
creating the securities, not even like issuing. They're creating the securities. It can be capital securities. They can be debt securities. Capital instrument or maybe the debt instrument. They're creating the securities and they're issuing for the first time to the public. They're rolling
Yes,
out
sir.
their to the
To
market
raising the
for the first
capital.
time.
Yes, sir.
So whenever they roll out new debt instruments, that's we call as a primary market. So even in the bonds also same case. If company is issuing, not only companies, even governments, RBI, like municipalities, all this can issue these bonds. It's not something like only corporate companies should issue the bonds. No, anyone can come and issue. Like municipalities can come and issue. We have a metro. Metro can come and issue. We have a Amaravati project, right? In Andhra Pradesh. Amaravati project. State government can also come and issue the bonds. Like government bonds will be there. Private bonds, I mean corporate bonds will be there. Municipal bonds will be there. RBI bonds will be there. Company bonds will be there. A lot of bonds will be there. We'll talk about types of bonds as well. So all these instruments, when they're issuing directly from the, I mean, when they're issuing to the public for the first time, that's we call as a primary market. Again, these all instruments will be traded in the market. Again, we have stock exchanges and different trading platforms where we can go and purchase the bonds and fixed income securities. So in the trading platform, if you are going and purchasing the instruments, that's we call it as secondary market. But first time when you are purchasing the bonds and instruments from the company itself, that's we call it as primary market. Just as we have a concept called share capital, the same concept will be there in the bond market also in the primary and secondary market. Again, the appointment of all participants will be there, registers will be there, where the bonds will be issued. All these concepts will be there in the bond market also, but it would be bit different. Not going to be entire concept is going to be different, but in the price determination, issue price and everything bit different because the fixed income securities, right? It's not something like a bidding concept and all won't be there. So the process may be a bit different, but there will be a primary market as well as in the secondary market. Understood? Everyone?
Yes, Mahesh.
Yes, Mahesh.
Yes, Mahesh.
Yes. Now we'll talk about bond valuation. We'll talk about bond valuation. Now we understood about the bond market, right? Everyone?
Yes, Mahesh.
Yeah. Now we are going to talk about bond valuation. What do you mean by valuation? Suppose if you want to value one hotel, or maybe let's say, yes, let's understand from the hotel perspective. In layman terms, if you want to understand and if you want to value the hotel, it includes a building, the business, and everything. How you would value? Suppose the hotel is running in a building. The building cost is actual cost is 20 lakhs, and there is a furniture. Inside that furniture, there is a 10 lakhs worth of furniture, and this is the hotel. Okay, let's say assume we have a famous hotel in Bangalore itself. Famous, very famous hotel. Every day there will be a lot of turnover. Some lakhs of turnover will be there on a daily basis. But building worth is 20 lakhs, but the furniture worth is 10 lakhs. Suppose if they want to sell the value, I mean, they want to sell the hotel to someone else, how you will value that hotel? Is it going to be more than 30 lakhs or 30 lakhs only? Can we pay 30 lakhs to that hotel?
More
No,
than
no,
30
no,
lakhs.
more than 30 lakhs.
More than
basically-
30 lakhs.
So basically, how you are valuing this company, I mean, a hotel?
Goodwill.
For
Goodwill part.
Yes.
How you are valuing this goodwill? Maybe from last few months or maybe from the last few years, they're running the hotel. They do have a turnover, and so there will be expected cash flows as well. In the
Yes,
coming years, once we purchase the hotel, there will be regular cash flows. So
yes,
we'll consider.
monthly this much profit you will get like
Yeah.
that.
So all this we can estimate, right? Maybe we
Yes.
cannot tell exactly, but we can estimate. So by
Yes.
considering all these elements, we will value the hotel. Similarly, if I'm going to purchase the bond valuation is also very important. For the bond holder especially, the bond valuation is also very important. Guys, understand one thing. We are not doing the accounting work from the company perspective. Companies are issuing shares, companies are issuing bonds, companies are selling the shares, company is paying a dividend. Forget about from the company side. We are talking from the investor's perspective. We're talking from the investor's perspective. Investor is purchasing the bond. Okay, let's talk about from the investor's perspective. As an investor, I'm purchasing shares from the company. From the investor's perspective, what he will get, how he will get, how much he is paying. From the investor's perspective only, we'll try to understand. Okay, keep this point in your mind. Whenever we are discussing about the investment, bonds and everything, from the investor's perspective only, we have to think, not from the company perspective. Got it?
Yes, sir.
Yeah, Mike. Yeah,
Any
Mike.
doubts? Why, sir? We are going to work
No,
on
sir.
companies, right? We are going to work on companies, right? Why we have to think from the investor's
Investor,
perspective?
right.
I'll tell you. I'll tell you the reason as well. Okay, by end of the session,
Okay.
I'll tell you that one as well. Why we have to think about from the investor's perspective. Okay, we are talking about the bond valuation. Why we have to consider this bond valuation? Basically, the bond valuation means, suppose there is a bond value, let's say 1,000 rupees bond value. The bond value is 1,000 rupees, and there is an interest element 3% per annum. 3% per annum. Okay, and it is issued for 5 years. So after 5 years, how much you will get?
15.
Can anyone tell me? Suppose they're paying every month interest, and interest payment is annual payment. Interest is annual payment. We will consider the cash flows now. Okay, let's divide the cash flows. So the first year, how much I'll get? First year
First year,
ending
30
360.
rupees.
5 years.
30 rupees. 1 year ki
360
30
rupees.
rupees.
So it's 1,000 rupees, right? So 1,000
Ah.
rupees
Yes,
into 3%.
3 into
You will get to 30 rupees.
First year, ma. I'm talking about first year. First year return is 30 rupees.
30 rupees. So
And
5 years.
second year, how much interest I'll get?
30.
30 only.
30.
It's not going to change, right? Because it's a
Yes,
fixed.
sir.
Fixed
It's a
interest
fixed.
Yes, sir.
rate of
So I'll be
interest.
getting only 30 rupees.
Finally 150.
Final 150, sir.
And fifth year, 30 rupees I'll get interest. In addition to what I'll get?
1,000 rupees, sir.
The
Capital.
principal amount also, right? The
Capital.
interest
Yes,
amount
sir.
as well as 1,000 rupees.
Capital.
So
Yes,
1
sir.
lakh. I mean, sorry,
Yes, sir.
1,000 rupees, 1,030 rupees I'll get in the fifth year.
1,000.
So what is the total amount I'm getting? What is the total return?
1,150, sir.
1,050.
Total return. I'm saying total return. Understand?
What?
This 1,000 rupees is not
Yes,
your
sir.
return. 1,000 rupees is your investment. How
Yes,
much
sir.
you'll get?
150.
150 only
150
return.
rupees, sir.
150
150
interest.
rupees. How you guys
the
calculate this
profit.
150 rupees?
Interest for first year, second
30
year, third
into
year,
30 rupees into
5
5
years.
years of interest.
5 years, every year we're getting 30 rupees. Let's assume on fifth year is we are getting 1,000 rupees cashback as maturity. So that is also the capital return.
Yes, sir.
But 150 is the return. Okay, let me keep it in a different way. You are giving, suppose, how should I explain this? I'm giving this bond for 40 years. For 40 years.
okay.
Okay, 40 years. Every month I'll pay 3% interest on. Every year I'll pay 3% interest on. So on 40th year also, you'll get how much interest? 30 only, right?
30 only.
30 rupees only you'll get.
Yes, sir.
No.
Yes,
Ah,
yes, sir.
I'm
Yes,
talking
sir.
about interest only. Forget about principal amount.
Okay.
Principal amount all will
Okay.
receive
Every year
1,000 rupees only. On 40th year also, 30 only you'll get. Let's see. On first year, today, this year, we are getting 30 rupees for 1,000 rupees investment.
Yes, sir.
yes.
Is it sounds good? Okay, right? The 3% interest nowadays is good, right?
Good.
Good, right?
Yes, sir.
Yeah.
Nowadays,
After
it's
40
good.
years, you're receiving same 30 rupees. Is it the
Yes,
same
sir.
value?
No, sir.
No. No.
That is the bond valuation.
Based
No.
on interest.
I'm talking about the value of money. This year I'm getting 30 rupees, and 40th year also I'll be getting 30 rupees only.
That is less.
Should I consider like that?
That is
No.
not fair.
Not fair, sir.
It's not going to change. We cannot change 30 rupees. Maybe we cannot even expect bond price of, the bond interest rate will increase from 4%, 5%. There won't be chances. It's a fixed return. But still, I want to decide, is it good to purchase or not? Here we are considering for 5 years, okay, 150 rupees return I'll get. I can assume, okay, I'm investing 1,000 rupees, I'm getting 150 return. For 5 years, 150 return is a good or bad, we can assume.
Okay, sir.
I'm trying to convey the value of money. Time value of money. Do you know the concept of time value of money?
Yes.
Time value of money. Do you know the concept of time value of money?
Yes.
The value of money will differ from time to time.
Time
The
to
value
time.
of money will
Yeah,
differ from time to
Time
time.
to time.
To time.
Let's assume we have 100 rupees today. 100 rupees value
Tomorrow it
today
will be.
is very less.
Yes.
Yes,
Maybe
sir.
even like school children will have a pocket money for 100 rupees, right? If you go to
Yes,
DMart,
sir.
how many items you can purchase with 1,000, 100 rupees? If you go to vegetable market with 100 rupees, how many items you can purchase?
Is three items, 4 items.
2 to 3.
Today I ordered this one. What is this?
Biryani.
రిచ్ వన్ బీరకాయ అంటాం కదా, అది ఆర్డర్ చేసిన. ఒకటి వచ్చింది 50 రూపీస్, ఒకటే వచ్చింది హాఫ్ కిలోకి. స్టిల్ ఐ రిమెంబర్ మై ఫాదర్ యూస్ టు గో టు ఏమంటారు సంత అంట, మార్కెట్, వీక్లీ మార్కెట్స్ విల్ బి దేర్, రైట్, in our
yes,
local
yes.
villages with
Yes.
30 rupees, 40 rupees when we were a kid, just like 15 years back, or let's say like 15 years back when we were in a 6th standard or 7th standard, we used to get a vegetables for the entire month for 30 rupees, 40 rupees.
Yes, Mahesh.
Yes,
Max,
sir.
Because
when I was in a 10th class also, I still remember I used to go to the market For 100 rupees for a whole month is easily I can get carrot, kal kilo, half kilo. All this I'll be able to get. We will be able to manage for whole month with 100 rupees money. But nowadays, can we get 100 rupees? Anything
No.
like that?
No, sir.
Same rupee, right? Same 100 rupees, right? 10 years back also
Be-
same 100 rupees. Now
But
also
yes,
same 100 rupees.
because of inflation, every year will be changed the inflation
The
rate.
value
and-
of money, the value of currency is reducing by year, right?
Yes, yes.
Correct.
So-
By the time yeah, the Indian rupee is equals to dollar is 40 rupees, now 80 rupees.
Yeah. So why it's happening like that? The value of currency, value of rupees reducing from year by year because of the inflations and different reasons. Now, if you want to value the bond, similarly, if you want to value the bond, we are saying that 50 year we will get 30 rupees. Now we are considering how much return you will get. You are saying like 150 rupees return you will get, sir. But 50 year, this 30 rupees return, I mean, that 30 rupees value is same.
No, it's not same.
Definitely, it's not going to be the same, right?
Yes.
Yes.
Yes,
Today, this year, okay, 30 rupees value. This year, 30 rupees value only we have.
Okay.
After 5 years, I'm going to receive 30 rupees. But today itself, I want to decide because I'm investing 1000 rupees today, not after 5 years. Today, I'm investing that 1000 rupees. I'm expecting return after 5 years also. Are you getting the point?
Yes,
Yes.
yes.
It's a bit difficult and crispy. Try to understand. I'm investing today itself 1000 rupees. And every year, I'll be receiving 30 rupees interest. But if I consider, okay, every year I'll be receiving 30 rupees total, I'll get 150, 1000 rupees, 150 return is good or not. If you are going to consider in this way, it's incorrect valuation.
Correct.
Because after 5 years, the value of 30 is not going to be the same 30 rupees. The value of 30 rupees may be like 25 rupees or 22 rupees, right?
Yes.
I need to
Yes.
consider that amount now. I need
Yes.
to consider that value. So understand, guys, the valuation of band is nothing but the present value of future cash flow. The present value of future cash flow. Try to understand this word. It's very important.
Yes, yes.
Guys,
Present
keep it on
value.
mute. ఎవర్రా అది నాకు హెడేక్ గా ఉంది చాలా కూల్ గా చెప్తున్నా దయచేసి వినండి అబ్బా మాట్లాడుతండి సో రిమెంబర్ దిస్ వర్డ్ వెరీ ఇంపార్టెంట్ ద ప్రజెంట్ వాల్యూ ఆఫ్ ఫ్యూచర్ క్యాష్ ఫ్లోస్ వాట్ ఈస్ ఫ్యూచర్ క్యాష్ ఫ్లో హియర్
Interest
What is the
rates.
future cash flow?
Interest.
Second year, this year is a current year cash flow. From next year, second year, third year is a future cash flow. In future only, I'll be receiving the money, right?
Yes.
So that is called future cash.
Yes, sir.
And what is the value today? That future cash flow value that I need to consider. Then I'll be able to assess the value of a bond correctly. Like whether I'm going to good to invest in this value of this bond or not. In that way, I can assess. That is called bond valuation. Bond valuation is nothing but calculating of present value of a bond. Present value of bond with the future interest payments. With the future interest payments.
Yes.
And also this 1000 rupees. I'm going to receive this 1000 rupees on 5th year. But I have to pay 1000 rupees now itself. I'll expect this 1000 rupees on 5th year. But on the 5th year, there won't be same value for the 1000 rupees, right? The 1000
Yes.
rupees value will also change.
Yes.
So that value also I need to know now itself. Getting the point? Forget about how we will get to know. At least you understood the concept, right? We have to
Yes,
assume
yes.
at least, okay, this is the value in the next 5 years.
Correct.
Yes,
Yes.
sir. Yes,
In
sir.
that way only we have to consider, right?
Yes,
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 Mahesh.
yes.
Yes,
So
sir.
that
Yes,
consideration, if I'm going to consider the future cash flows, if you want to value the bonds upon maturity, that's we call it as bond valuation.
Okay.
The future payment of a principal and the future payment of interest will be considered, and we will value to the present money.
Okay.
That is called bond valuation. We have specific formulas and different parameters will be involved in the bond valuations. We will discuss those bond valuation concepts. Now you understood as of now, right?
Yes,
Everyone?
Yes,
It's a very
Mahesh.
simple concept, guys. It's not going to be a bit difficult or different. Again, we don't need to spend a lot of time on this one. If you get any question about bond valuation, you should remember this concept in your local language. It's not even required to expect all this concept in English itself. Okay, you have to remember the concept in your mind, and you have to quote only 2 words. One is the present value of future cash flows. It's nothing but determination of present value of future cash flows. What are the future cash flows? The principal amount and the future interest amounts. That's it. That is called bond valuation. We don't need to extend anymore.
Okay.
If they ask you to calculate a formula, I mean, what is the formula to calculate the bond valuation? That we can different topic. We'll talk about it. What is the bond valuation capacity? How we will determine and all? We will discuss later. Is everyone clear with this as of now?
Yes, yes.
Yes,
Okay.
Mahesh.
Yes, sir.
Okay, good guys. So I'll stop the recording here. I'll have to stop the recording.